Welcome, everyone. Nice to see you all here with me this evening. I hope everybody's being safe and sane with everything that's going on in the world out there. But nice to have you all join us. Appreciate you taking your time out of your busy schedules to learn about retirement matters. So that's what I have on my screen here. So welcome. I'm Kelley Slaught. California Wealth Advisors is our company here. So we have these different seminars for folks to help educate them, which those of you that know me know that I love educating folks on investments and how they work. So we have these different series. I will be having a lot more of these coming up, these Zoom meetings, webinars. I miss being in front of all of you. I prefer to be in front of a crowd, but this works fine as well. And these all go on my website as well. So you can always refer people to CaliforniaWealthAdvisors.com and send people there to watch me if you've got to get out early tonight, or if you have a friend that wants to find out a little bit more about what we do. So welcome. Appreciate you being here. All right, let me start here with never before. So why do I have this up there? And those of you that have seen me do these before this is gonna be a little bit of a repeat for you. But again, a lot of times I do these webinars and the information I give might be the same information you've heard before, but I might say it in a little bit of a different way. So I always have clients tell me, boy, I listened to you 5, 10 times, but I learned something different each time I listened to you. So anyway, never before. Why do I have this up here? I have this up here because right now in America, we are facing something that we've never had before. It's getting bigger every day. It's going to affect everybody in the United States in one way or another. It's going to have dramatic implications across this nation as well. It's been going on for the last number of years and will continue to go on for the next number of years as well. So what am I talking about? I'm talking about retirement. I'm talking about retirement for the baby boomers. Many of them are retiring, and there's this huge influx of people that need retirement advice. So again, this is why I have these kinds of webinars for you to educate you on retirement planning. So it's interesting because a little fact that I have is that when Franklin Roosevelt signed the Social Security Act in 1934, he set the retirement age at 65, but life expectancy at that time for the average American was 62 years old. So 62 is when you were supposed to pass away. 65 is when Social Security was supposedly to start. This was 1934. So wasn't that a little interesting trick that he had there? So obviously we're living way more longer, many more years now. We're living longer, so we've got to plan for that. And it's a challenge for folks. I mean, Social Security and Medicare are very underfunded. They're in deep holes, both of them. So I don't know how the politics of all that will work out in the future, but we need to plan for it, whichever way that works out politically, and make sure that we're covering, we can have income and assets for the rest of your life, for 30, 40, 50 years sometimes when people retire, because we're all living into our hundreds. I've got some quotes I'll give you in a little bit. But the good news is we have plans, we have strategies, you can achieve your goals. So don't feel like you can't do it out there, because you can. We do have ways of mitigating some of the longevity income streams that you might need guaranteed for your life. We do have ways of handling that. So you're in a good place. All right, so let me go on. So again, retirement matters is what we're going to talk about here. This is my Financial Matters series. So I will have a number of them. I have a women's seminar coming up. I think it was next week or the week after. I have one of the money managers that we work with going to be doing a webinar for us too. I have a couple of CEOs coming in doing webinars for us. So look at my California Wealth Advisors website and it'll have upcoming seminars, webinars on there for you. Okay, again, my name is Kelley Slaught. I've been doing this for quite a long time, started in the industry in 1982. I definitely help clients make financial decisions for their portfolios. I help craft portfolios for folks depending on what they need, your risk tolerance, your time horizon, your income needs that you might have. So I love doing it. I'm incredibly passionate about what I do. All my clients on this call here will know that. Some of you new folks that are just getting to know me, I absolutely love what I do. I've been doing this a very long time, and I love sitting down with people, making their portfolio into what it is they want, because everybody's different, which makes my job very interesting, actually, because everybody's so different with what they like. So I'm tonight going to talk about my background a little bit. My firm is California Wealth Advisors. By all means, go look at my website. It's getting really good. My staff has worked very hard on making that interactive and a lot of good information on there. I am absolutely committed in helping you all create the portfolios that you need, as again, everybody's different with that. So tonight I'm going to introduce you to some concepts you maybe haven't seen. I'm going to educate you, absolutely, and I'm going to illustrate for you at the end some strategies on how best to manage your portfolio and how to go forward from here. There's really three areas of investing. Actually, before I get into that, I am going to have an evaluation form at the end tonight. I highly encourage you to fill that out for us if you would. It gives us a lot of good feedback on these webinars, how we can improve them, if my voice isn't coming through clearly, or I didn't cover a subject in depth enough. We need to know. I want to improve these. I'm always willing to take advice from folks. So by all means, fill this out for us. And it gives it, so from that standpoint, but it also gives us a good spot to start from for new people that want to talk to us, or my clients that are here that maybe you have an issue that we haven't discussed yet. So put that on there, please. So by all means, fill that out for us. We highly appreciate it. Also on here, I am going to reference a couple of different tools I can send you. So if you want me to send you those, reference that on your evaluation form, and I'd be happy to get those out to you once we talk about that. Okay. Before I get too into the depth here of what I'm going to talk about, there are three different levels of investing, or three different time frames of investing, I should say. You've got the accumulation stage, which is when you're usually younger. You've got more risk tolerance at that stage. Perhaps you're putting money in your 401k, your IRA, you're buying real estate, you're starting your business, whatever you're doing, that's the accumulation stage. Then you get to the preservation stage. So that's your pre-retirees or retirees in the preservation stage. I don't want to lose my money. I had a client in today saying, I don't want to lose my money. Well, that's preservation stage. I don't have 20, 30, 40 years ahead of me that I'm going to be working to create more income to accumulate, what I already did. So you want to preserve the assets that you have. Then you turn into the income and or legacy passing stage, income legacy passing stage, to create income from these assets to live on so you don't have to work, or perhaps you want to leave a legacy for your loved ones. So we want to plan for that. We absolutely want to plan for that. So three different stages: accumulation stage, preservation stage, income stage. What I like to do, the thing that's in my head about how I help people is I have, if you will picture with me, a picture frame on the wall that's just a blank frame. And on the table in front of that frame is a bunch of puzzle pieces. And my job is to help put those puzzle pieces up and make a beautiful picture for you in retirement, to help you either get to retirement or plan through retirement and make that picture exactly what you want it to be. And again, everybody's picture is different. So I love helping people do that. So number one and number two for me, you'll learn as I speak here tonight that diversification is absolutely key. When I talk about strategies towards the end here, I'll talk about diversification and how you can do that. And having a plan. Having a plan is so important, so very important. And that helped so many of my clients through this whole COVID situation we just went through, because I have a plan. For all of my clients, I have a plan. And no one panicked through this whole COVID situation. Nobody liquidated anything. We stayed the course. We were status quo. We got through it. And that's how you preserve your assets and how you make money through situations like we just went through. So I was a calm voice in the storm for all of my clients. I did not panic. We have a plan. Sure, yes, absolutely. We change things around periodically, but we don't panic for anything. Any kind of financial thing, political thing, we don't panic. We manage through it. So anyway, that's interesting prospect to think about when you have 2008, 2001, COVID. Don't panic. Have a plan. Very, very important. Okay, so let me go on to some more of my slides here. Let me leaf through what I've got. All right, so one other thing I want to cover here before I get into the slides here is the five most common mistakes that I see investors making with their money. The number one pitfall, investor mistake, is don't invest before creating a plan. Okay, what did I just say? Number one, number two, number three, number one and number two thing for me is having a plan. You need to have a plan. So don't invest before you have a plan. So that's what I sit with people and I do before we actually make an investment in anything, is we sit down and we map out what do we want to do with the different investments they have. A lot of people have IRAs, 401ks, different things. So have a plan before you make an investment. Number two pitfall is avoid making investment decisions emotionally. So we never do that here at California Wealth Advisors. We have a plan. We stick with it. We don't, the stock market goes up 1,000 or down 1,000 tomorrow. We don't emotionally think about how we're going to invest. Number three is don't try to time the market or pick winners. Don't do that either. I have never seen that work. Sure, you can have ideas about different things, and we can certainly discuss it, but to try and pick winners and pick losers or time the market in any way is really doesn't work that well. I've never seen it work very well. Number four is not properly diversifying your portfolio. So again, when I talk about the strategies at the end, I'm going to talk about diversification. Got to have diversified portfolios. Don't all have all eggs in one basket. Invariably, people bring me their 401ks, their IRAs, and they're all in the market. They don't realize they're all in the market, but stocks, bonds, and mutual funds are all in the market. They all trade. So maybe let's take some money off of that section of investing and do some other things with it. And again, I'll talk about that in a bit. Number five pitfall is acting on investment advice from the wrong sources. So that would be your neighbor Bill that lives down the street, your office worker friend Sue, and they might have some great suggestions, but are those the best sources to take financial advice from? So just know your sources when you take advice from folks. This is an interesting fact that I always like to say because it shows so clearly how if you don't have a plan, what can happen to you. So 1 in 6 NFL players will go bankrupt within 12 years of retirement. 1 in 6 NFL players will go bankrupt within 12 years of retirement. Now that is amazing to me and a very sad statistic. 60% of NBA players go broke within 5 years of leaving the game. So, don't get caught up in these huge assets you might see in a 401k or something. Make sure you have a plan and you stick with it. Okay, so tonight I'm going to talk about retirement living concerns. These are the 4 sections I'm going to go over here. So the tale of 2 retirements, retiring in a bull market versus the bear market. I'll look at healthcare and Social Security. I could spend 5 hours on healthcare and security. I'm going to cover it briefly. I can go into more depth with you individually, but I will cover that a little bit. Inflation and spending, very important to have this as part of your portfolio. Diversification, having a plan, and inflation hedges are really the top 3 things I look at whenever I do a plan for anyone. Then finally, I'm going to talk about strategies for retirement living. So how do we manage through this? What do we do to mitigate any of these concerns we might have? Okay, let's go on to the tale of 2 retirements. All right, this is fascinating to me. So when you retire in a bull market, and this is all money in the stock market. So these are the scenarios I'm going to give you right here. I'll give you other scenarios when I talk about strategies. But in this case, since most people end up being here because they don't have good financial advice, they're all in the stock market. So you're retiring in a bull market. So that means the market goes up for a number of years. Okay, so this person has $500,000 they invested in 1991, which was the start of a bull market. They needed $70,000 a year to live on to supplement their income. So they took out $70,000 a year for these 10 years it shows up here. And at the end of 10 years, the market had done well. So they were left with about, let's say, $750,000 at the end after having taken out $70,000 a year. Well, that's great. We love that scenario, right? Wonderful. Do we really know if it's a bull market or a bear market today, if you're retiring today? No, we don't. I mean, I do have a crystal ball behind me here, but she doesn't always tell me what's going to happen in front of us. All right, let's look at this other scenario, a bear market retirement. So this person has $500,000. Again, they need $70,000 to supplement their income, but we're in a bear market. So look at this. By 2007, let's say, they've completely run out of money. They don't have the $70,000 anymore. Their assets are down to 0. We do not want this scenario to happen to you. Again, I'll talk about strategies when I get to the end here, but it's really important to look at, well, do you know if it's a bear market or a bull market? Because we don't know what's coming ahead of us. So let's try to mitigate any kind of things like that might happen to your portfolio. Okay, let's talk about healthcare and Social Security. All right. I thought this was an interesting fact. Since centenarians, those living to 100 or beyond, now number 82,000, up from 50,000 in 2002. So we are an aging population, that's for sure. Those 100 and plus are America's second fastest growing age group. And those are 85 and over are the fastest aging group, fastest growing age group. So again, we're all living longer. We've got to mitigate the risk for living longer. We've got to do things that manage through the years we have ahead of us, that have income streams guaranteed for us, have maybe downside protection for our portfolio as well. So anyway, married couples retiring at age 65 will likely live to age 84 for men, 86 for women. If you live to that age, you have a 10% chance, more of you, 25% to 10%, living to age 90, 100, or 90, 95, or 100. And what's interesting here is 43% underestimate the average life expectancy. So if we knew exactly the day we were going to die and how much money we had today, boy, we could make that an easy calculation, couldn't we? But we don't know that. So what I do is I usually ask folks, well, what is your longevity that you expect? What kind of physical shape are you in? How long did your parents live for? We are all living longer, and medicine has gotten way better for all of us. So that's a good thing, but we need to plan for it. Okay, healthcare costs in retirement. Of course, healthcare costs have gone up quite a bit. My next slide will show that. But this is the confidence of pre-retirees that they have in healthcare costs. So 44% of retirees say that their healthcare costs are higher than they expected them to be. So you've got to plan for healthcare costs. Long-term care is the number one concern I have from clients when they come see me. How am I going to pay for my long-term care? If I need that, who's going to pay for it? I don't want to be a burden to my family. Again, I'm going to talk about that in a little bit. I'll go into depth a little bit on how to take care of that. Again, long-term trend in healthcare costs have only gone up. You've got to plan for it for the future, that's for sure. All right, let's talk about inflation and spending here. Always interesting to talk about this. A new house in 1968 was around $15,000. 2018, it was about $302,000. So obviously a huge, big increase here. Now, those of you that live in Santa Barbara or Southern California that are watching this with me know that you can't buy much for $302,000 in California. This is across the United States. But it's always interesting because a dollar today does not equal a dollar tomorrow, does it? I mean, a gallon of gas in 1968 was 34 cents. Would we love to pay that today? Yes, we would. I think it's closer to $3.50 or so today. This is 2018. So always interesting. I like looking at this one too. 1968 income was about, let's say, just under $8,000 a year. That's what you could live on. Today, 2018, it was $61,000, and that in California is not going to get you too far either. A couple I like to throw in here is the cost of a Mustang in 1960s. How much did a new Mustang cost, Ford Mustang in 1960? And my notes show $2,300 is what they were. I think they're closer to about $60,000 today for a new one. The other one I like to talk about is college. How much did the private school cost in the 1960s? How much did it cost to go to a private university in the 1960s? And it was about $475 a year. And my daughter, my youngest, just graduated from college. She graduated from the American University of London, but she did get into USC here. And if she had gone to USC here, it would have cost her about $75,000 or more per year. It cost me. It wouldn't have cost her anything. It kind of falls on mom. Would have cost quite a bit more than this $475 it cost in the 1960s, that's for sure. So your dollar today does not equal a dollar tomorrow. You've got to have inflation hedges in your portfolio. So that's the whole point of me telling you this is have inflation hedges inherently built into your portfolios. All right, expectations versus reality. Actually, before I go on to this slide, I do want to talk about Social Security a little bit. I will talk about it on the slide further down, but Social Security benefits are based on your lifetime earnings. And the formula, it can be a little bit complicated, but it averages income from your 35 highest earning years. They take the last 40 credits, they call them, 4 per year that you get, and they take the highest 35. And that's how they figure out Social Security for you. If you have not gone to socialsecurity.gov, please go there. You will have, it's really easy to sign in. You put a username and password in there, and it will show you what Social Security you can get at age 62, 66, which is full retirement age for most folks these days. If you wait to age 70, how much you can get there. So you can kind of figure out what your income might be for Social Security. So know what that is. The other question I get asked quite a bit is Social Security taxed? And it can be. It depends on your income. So if you're married filing jointly and you make under $32,000 a year, you have zero that's going to be taxed from your Social Security. However, if you make $44,000 or more per year, married filing jointly, up to 85% of your Social Security can be taxed. If you're single and you make under $25,000 a year, then zero will be taxed. If you are single and you make over $34,000 a year, up to 85% can be taxed. So just know that Social Security can be taxed. Also, I do these reports. I know this is small, but I do these reports for folks to find out when's the best time to take Social Security, because it's different for everyone. I usually tell folks don't take it at age 62. That's the lowest dollar amount you will ever get from Social Security. Every year that you wait after that to full retirement age, you're going to get 8% more per year. So I usually recommend, if they can, to wait to age 66. If you can wait to age 70, that's even better. You're going to get more. And usually the crossover to that is about 10 years after you start taking Social Security as to when you should start taking it versus not, or if waiting till later. But again, I can run those reports for you. Just let me know on the evaluation form at the end. I'd be happy to sit down and help you with that. Okay, expectations versus reality. So workers versus retirees. So 68% of workers expect to work during retirement, but actually 26% actually do. So a lot less people work during retirement than think they're going to. 53% think that their employer-sponsored retirement savings plan will help fund their retirement, and actually only 24% pays for that. And this last one I think is interesting. So Social Security, this is employer-sponsored retirement savings. So this is Social Security down here. 36% of people think that Social Security will pay for part of their retirement, but actually 67% use Social Security. So it's a big difference there of what people actually use Social Security for. A lot of people think they're not going to use that much of it, but usually they do. So know what Social Security is for you. Socialsecurity.gov, absolutely go there and check that out. Okay, I want to talk about spending and budgets here. So know what your budget is. It's really important to know what your budget is. Different for everyone. Everybody has different, maybe some people have paid off their house, maybe some people haven't. Maybe you like to travel, maybe you don't. Maybe you want to go see your grandkids. Maybe you want to send money to your favorite charity. But know what your budget is. It's really important to know that. So I'm going to go to my full screen camera here and go over budgets, because this is very important to know, especially as you approach retirement and into retirement. Know what your budget is. So what's your gap? Everybody has a budget gap. So this is you, this is your house, this is your loved ones. So maybe you tell me, hey, Kelley, I need $10,000 a month. I had a client today just told me that. I need $10,000 a month to retire on. I said, okay, well, what income streams do you have? And most people have a pension, perhaps, or they have Social Security. So this person is getting $5,000 a month from their pension and their Social Security. So, okay, what's the gap? Well, they're looking for $10,000. So that means I've got a $5,000 gap here. I've got to fill in to try and get you to your $10,000. Well, where am I going to go for that? Where am I going to create income for you? Well, I'm going to go to your 401k, perhaps. I'm going to go to your IRAs. Maybe you have Roths, IRAs, SEP IRAs, 457s. There's different retirement accounts. Maybe you're going to work a little bit. Maybe you're going to consult. Or maybe you have rental properties, or you have other investments that pay you income. So that's where I'm going to go to create this other $5,000 you might be looking for. So again, budgets are really important. Know what your budget is. On my website, and or I can send it to you, I have a budget sheet that will go over or ask you questions, what income do you have? What taxes do you pay? All sorts of different questions like that. So by all means, fill out that budget sheet. It's really important to know what your budget is when you retire. And it can change. I change with folks all the time, but the budget sheet's important to know, important for you to know. All right, let me go back to my slides here. All right, spending patterns, we covered this a little bit. All right, this is important to kind of just think about as you take out more money. So let's say you have a portfolio, you have $1 million and you're taking out $80,000 a year. Well, if you didn't make any money off of that, you just straight took out $80,000, it's gonna last you about 15 years. If you have $1 million and you're taking out $40,000 a year, well, it's gonna last you a bit longer than that. So just realize when you structure portfolios for yourself, know what your spending patterns are, so you know kind of what income you need each year, and try not take out the principal. I try not touch the principal. I mean, this 80,000 scenario here is taking out the principal every month to pay this 80,000. So I try and generate income off of the $1 million in this case to create the 80,000 for clients, so they don't have to touch their principal. So just important to know that. The other thing that you might want to think about here too, especially in this year, is looking at Roth conversion. So I have a sheet here that talks about the tax bracket, the different tax brackets and the levels, 10%, 12%, 22%. Find out what your tax bracket is. Again, it's different for everyone. Because this might be a great year as far as Roth conversions go. I have a lot of people ask me about those. And because of COVID this year, a lot of people have lower income than they normally would have. Perhaps they've had to shutter their business for a while, their restaurant, whatever, but they've got lower income. So it might be a good year to take some money from a retirement account, it could be a 401k, it could be an IRA, and transfer that into a Roth. Because once you do that, the money that grows in that Roth account for you is tax-free. And you don't have required minimum distributions like you do for 401ks and IRAs when you turn age 72. They increase it to 72, not 70 and a half anymore. So it might be a really good year to do a Roth conversion. Now, when you do a Roth conversion like that, whatever you take out of the IRA 401k is a taxable event to you, goes to your tax, goes as ordinary income taxes on your tax returns. So you want to make sure you keep yourself below whatever the next tax bracket is. So if you're in the 22% bracket, you want to make sure you're not thrown up to the 24% tax bracket with how much money you put into the Roth. So you want to make sure you keep that below, and I can help you with all of that. But anyway, I wanted to bring that up, because a lot of people do ask me that kind of a question. Okay, let's go back to the slides here. All right, so strategies in retirement living. So this is really important to know. How do I manage through the 30, 40 years I have ahead of me of retirement, the ups and downs of the stock market? How do I manage through that? So I'm going to give you some ideas here. It's important to know your risk tolerance. So again, on my website, I have something called Riskalyze, and there's about 12 questions on there. And again, if you want to put this on your evaluation form that you'd like us to send you the Riskalyze questionnaires, we can do that. But know what your risk tolerance is, especially when you're in stocks, bonds, and mutual funds or cash. And this is a typical 401k account I see because that's all the choices they have. So 401ks typically are 100% in the market, 100% in traded securities of some kind. Now, the stock market on a 0 to 100 scale is somewhere between a 70 and 100 as far as risk goes. If you said to me, hey, Kelley, I don't like risk, I don't want any risk, and I'm a 5 or a 10 or a 20, after you fill out the Riskalyze question, it'll give you a number, and it'll tell you what your risk tolerance is. So if you say, hey, I filled it out, and I'm a 20, let's say, and you're right here in your 401k, you have stocks, bonds, and cash, well, you're a 70 to 100 in your portfolio here, but you're actually a 20. Well, we need to change the allocations that you have in your portfolio to make it equal what your risk tolerance is. So really important to know what your risk tolerance is. Riskalyze will do that for you. So by all means, fill that out for us. All right. Rebalancing your portfolio. So I do see questions periodically come in to me about rebalancing portfolios. Through COVID, we had markets up and down and sideways. People that were in tech positions, tech stocks, are now overtly balanced in tech stocks because they've gone up quite a bit, which is great. However, it might be time to take some of that money off the table and put it into some other safer investments, especially if you're in that preservation or income legacy planning stage. So rebalancing portfolios is really important to do, especially through times like these. Okay, this is what makes me different. I get this question all the time, or I see one up here. Why would I come to you? What makes you different from other advisors? This exactly is what does it. And my mass proprietary process, I call it. So M being managed accounts, money markets, mutual funds, anything to do with the stock market. So again, this is going to go up and down in this light blue section here. It's a good thing that it's liquid. Stocks we can sell, buy and sell any day of the week we want. So can we with mutual funds or managed accounts. It's very liquid. It's also very volatile. So expect that with this light blue section. A lot of my clients love these alternatives section here, this dark blue. Alternative means anything that doesn't trade with the market. So that's a good thing. A client might want something that's not traded every day like it is in this light blue section. A good thing about it is it doesn't trade every day. A bad thing about it is it doesn't trade every day. It's not liquid. We're going to put money over here. We're not going to be able to take it out tomorrow like we could the stock market. Now, what do you get for that? Well, you get usually income streams from it. This is real estate over here. It could be leasing programs or loan programs. It could be anything that creates income for you or is at least alternative to the stock market. So I'll just use real estate as an example here. So a lot of the real estate programs we have generate income off of the rents of the properties they own in there. Could be 4, 5, 6%, somewhere in there. Typically, these programs will last about 5 years. They could be 2 years. It could be 7 years. It depends on the real estate and how well it's performing. If the CEOs feel like it's time to sell, then they will, and they'll send you your money back to you. If they feel like it's not a good time to sell, then they'll keep it for another year or 2 or 3. I use this section here a lot of times as bond replacements for folks, because back in the 80s, when I was doing a lot of municipal bonds, we had 9% state and federal tax-free 20-year bonds. Would we love to have those today? No such thing today. So I use this as a bond replacement over here because they have income streams and because they last about 5 years or so. They're not so much longer than that, but they can be longer. They can be shorter as well. But this is where we go for alternatives to the market. Bond replacements is what I use this for as well. So a good place to go. Down here, safe investments, this gray section here. So this is where we go. If you said, hey, Kelley, I don't like risk at all. I don't want to be in the stock market. Yeah, real estate's great, and maybe you've made a bunch of money in real estate, but I don't really want to be there either. I want to protect my assets. I want downside protection. This is where we go. So because this, okay, so what investments are down here? So this is annuities, this is life insurance, this is long-term care, this is any kind of an insured type of product is down here, because the light blue section, the dark blue section are not insured investments. You can lose money there, absolutely. I don't want to tell you something that's not true. Down here, the safe investments is where we go to protect your assets. So when you get to that preservation stage and income legacy planning stage, this is where I put a lot of folks' assets down here to mitigate the risk of these two sections. Okay, I'm going to go to my camera here and I'm going to take the time to explain annuities to you. And when I do live events, I always ask people in the crowd, who's heard good things about annuities? Who's heard bad things about annuities? And I get hand raises for both. Annuities are not good or bad. It depends on what you're looking for. And unfortunately, most advisors don't explain these very well. So that's why I'm going to take the time here to explain this to you, because it's important that you understand the difference of them. Again, annuities are not good or bad. I'm not trying to sell you on annuities at all. I'm just trying to educate you and explain how they work. So here's my chart here. I'm going to hold this up. So annuities. There's really three different kinds of annuities, right? There's a fixed annuity, which is like a bond. I talked about municipal bonds a minute ago, 9%, 20 years. Well, that was in 1982. Can't get that today. 10-year fixed bonds these days, and even annuities, are about 2 to 3% for 10 years. You get your money back after 10 years. You've earned 2 to 3% each year. That's a fixed annuity, a fixed bond, if you will. That's how fixed annuities work. Variable annuities is what I see a lot in 401ks, because they buy mutual funds. So it is in the market. Variable annuity is in the market. They go up and down with the market. They might have guarantees involved with them, but it's not explained very well how those guarantees work. It's really not on the assets that you own. It's just on the income streams that could be generated from them. But that's a variable annuity. So a fixed is like a bond. A variable annuity is really like a mutual fund. It's going to go up and down and never really know what you're going to get out of those kinds of annuities. Fixed index annuities is really what I use mostly, because in my view, it takes the best of both of these worlds. And this chart here kind of explains it. If you can see this with me, I can kind of hold it up a little closer here for you. So if you put in $100,000, for instance, and you had a fixed indexed annuity and the market went down, well, you'd be going down with it if you had a variable annuity, right? That's in the market. A fixed is going to stay the same, and a fixed index is going to stay the same. So your 100,000 is going to stay at 100,000. You're not going to go down with the market here. But let's say the market starts going up again. So here my arrows are showing up. Well, your 100,000 is now turned into 120,000, then maybe 140,000, and then the market goes down again. Well, your 140 is going to stay at 140,000. It's not going to go back to 100. That's a good thing. That's the downside protection that we offer with the fixed indexed annuities. You only participate in the upsides of the market, not the downsides. So that's why I like these for people that tell me I don't want any risk. I want to preserve my assets. This is a great place to do it. You get some capital appreciation potential from it. Typically, it's going to be anywhere from 4 to 9% as an average rate of return if I look over the last 30 years or so. This is not a guaranteed rate of return. What you are being guaranteed here is your principal will be intact. So you're going to have some years that are going to be zero. If the market's going down, you're not going to make any money that year, but you're not going to lose any money that year. You will have that happen with a variable annuity or anything that's in the stock market. Your assets could go down, not with a fixed index when the market goes down. So some years are going to be zero. I've seen these perform up to 9%, even higher than that. So that's why I say typically about 4 to 9% is what your average rate of return is going to be on these types of investments. Not a guaranteed though. It's guaranteed to not lose you any money. The gain is just going to depend on the market. And oh, by the way, you can create income streams off of these, which is again why I do these for a lot of folks, because the income streams that we get from these types of annuities are guaranteed to last for your life. So again, to get away from running out of money, for instance, in the bear market I showed you, the charts I showed earlier, you run out of money if you're in a bear market and you're taking out that $70,000 a year. Well, if you have a fixed indexed annuity and we turn on the income streams for you, then that money is guaranteed for the rest of your life. And oh, by the way, it's going to be increasing. I talked about inflation hedges earlier, right? This has inflation hedges built into it. I could run illustrations for you that will show it. If you put in $100,000, you take out income in 5 years or 10 years, and it'll show the income streams and it'll show it increasing over time. You have immediate annuities as well. If you put in $100,000, you can start taking money out today. You'll get less than if you let it grow for you for 5 or 10 years, but we can do that as well. So income streams are great, guaranteed for life and increasing. I like that. This is the only place I can go for that as far as these kinds of investments, because we take out money from the stock market, our real estate, we sell it, it's in the bank, we start living on that, that's going to go to zero as well. This is the only place I can make an investment for you that will have income increasing, guaranteed for your life. So there's a lot more to these, but I wanted to make sure I explained how annuities work. I also want to talk about long-term care here while I have the chance, because long-term care is the number one thing people ask me about, like I said earlier, to cover when they get into retirement. They don't want to be a burden to their family. So where do I go for that? Well, I go for life insurance policies. And I go to fixed index life insurance policies that work exactly the same way here, which is why I want to bring this up. Because the fixed index life insurance policies will offer long-term care attached to it. They will have a death benefit, so you put in $100,000, it might have a $200,000, $300,000 death benefit to it. And then, oh, by the way, you can do the same thing here as you've done with the annuities. You can have income coming out of your life insurance policy. And by the way, that will be tax-free. So you can get tax-free income from a life insurance policy. You can get long-term care from a life insurance policy. It's usually 2% of the death benefit, whatever that is. So it can be a pretty good amount. I've done some recently here that were about $10,000 or $20,000 a month you can get from the life insurance policy. Again, it depends on how much you put in there, how many years you put money in there, and all of that. But again, I can run illustrations for you to show you all of that. But it works the same way as this. You only participate in the upside of the market, not in the downside. And over long periods of time, you can get really nice rates of return from these kind of life insurance policies. So if you have a life insurance policy that's more than about 5 years old, you probably don't have the long-term care attached. They started adding that about 5 years ago for free. You didn't have to pay extra for it. So I can look at the life insurance policy that you have now and compare it to what we might be able to get you today that maybe will add long-term care and maybe income streams for you and improve and even increase your death benefit too. I do that a lot of times too. Maybe improve the life insurance policy you have, even if you've been paying into it for a number of years or if you bought it for more than 5 years ago. So I wanted to take the time to explain this because there are answers to questions that people have and concerns that people have these days. Oh, I see a question here about liquidation of annuities. Okay, liquidating annuities. Okay, annuities are not liquid really in and of themselves. You can take out 10% a year for free. So no questions asked, no fees or anything. You have to hold it for a year first. But you can take out 10% for free. So you put in $100,000, you can take out $10,000 a year for free. If you take out more than that, you want to take out $20,000, for instance, then the insurance company, not me, will charge you a declining surrender fee on whatever you take out over that 10%. So if you took out $20,000, for instance, you get the 10% for free, then or $10,000 for free, then you get the $10,000 they're going to charge you depending on how long you've held that annuity for. So if you've held it for 10 years, there probably will be no fee for you to take out money. If you've held it for 5 years, well, this is how it works. It's usually 9% the first year, 8% the second year, 7% the third year, and it goes down about 1% each year. So again, you own it for about 10 years, there will be no fee. You can take out the 10%, you can take out more than that. There will be no fee for you to do that. Okay, so anyway, I wanted to answer that question for that one that came in. All right, let me go back to my slides. Okay, so again, this is the world of investing here, as I said. Real estate is here, oil and gas is here, gold is here. Anything you can think of is in this scenario here. CDs, money market accounts, it's all right here. So when you diversify your portfolio into these three sections, and I'll typically do 30%, 30%, 30% in each one of these sections. However, everybody's different. Some people don't want to be in the stock market at all. They want to be down here in the safe section. So maybe we don't do anything over here in the stock market. So this is just a general view for you, but kind of what makes me different is this scenario here, how I manage this. What also makes me different that you might not know is I keep in touch with my clients. And those of you on the call today know I'm very good about keeping in touch with you, making sure your portfolio is doing what it's doing that you want it to do, making sure the income streams are coming in that you're looking for. Certainly we need to change things periodically. Things in your life change. I need to know that. So that's why I keep in touch with people. I always return phone calls. Unfortunately, a lot of advisors don't do that, which is amazing to me. But anyway, there are differences here that I bring to the table that maybe some people are not getting from their advisor now or looking for a new advisor to bring them those kinds of assets. One thing I did want to say about life insurance I thought was really interesting. I ran across this the other day. The English astronomer Edmund Halley prepared the first detailed mortality table in 1693. Life and death could now be studied statistically, and the life insurance industry was born. So 1693, the life insurance industry was born because they could track things statistically. I thought that was interesting. So life insurance and annuity have been around for hundreds of years. They really have. The life insurance and annuity companies I've worked with have been around, gosh, 200 years sometimes. So a long time. Okay, where is your money right now? Okay, this is really important. When you come to see me for the first time, I need to know where your assets are. Do you have real estate? Do you have IRAs, 401ks? What kind of savings accounts do you have? It's really important to know for you where your money is. And I have one of my assistants now working on some sheets that will print out for you, and you can fill in where exactly all your assets are. Because a lot of people don't know. They don't know where all their assets are. They don't know what their net worth is. We need to know that for me to do a whole scenario for you, to do a portfolio review. Okay, so this kind of just shows you income planning. So this is an annuity down here generating $50,000 a year. You can see that it's increasing. So we like that. This is increasing by 3% a year. Again, those inflation hedges are really important. When you have other investments and maybe you're taking out some of the principal, that's going to decline for you over time. So we want to make sure we have this scenario going for you, at least for part of your investments. So again, annuities down here building principal and other assets maybe that are taking it out. Then you've got maybe more buckets of assets that you have, 3 pools of assets, building principal, taking money out, maybe taking money out faster. So know where your money is, know how it's creating income for you or not creating income for you, know if you're taking out principal or not. That's important too. So again, knowing the distributions from your retirement plan is very important. And again, I work with folks a lot of times with handling how to best do that. And tax-free income, we can generate that for you too if you have trust accounts or retirement accounts. All right, let me talk about trust accounts for a minute here. So I use Marty Yarnell. Here's his business card and his brochure. Marty Yarnell is my trust attorney I use. He's based out of Westlake, but he can deal with people all over the country. Setting up trust accounts. If you don't have a trust account, you need one. It's how to protect your assets. It's how to protect your heirs from not having to go through probate and fighting over the assets that you might have. Have a trust account. If you haven't looked at your trust account in the last couple of years, I would highly recommend you do that. If you have a trust attorney you like, that's great. Go back to them and readjust. Make sure your beneficiaries are who you want them to be. Update your trust. Again, if you haven't looked at it in 2 years or 10 years, then update your trust. Trust law changes over time. So by all means, talk to Marty Yarnell. Again, put that on your evaluation sheet at the end here if you'd like me to send you the trust attorney's information. If you're getting close to age 65, you need to talk to a Medicare specialist. Ed Holdren is who I use for that. He's here in Santa Barbara, but he can deal with people all over the country. But you need to walk through what is right for you for your Medicare choices. There's, believe me, ad nauseum choices for Medicare. It's very confusing to figure out which ones to use. Ed is a free service, so by all means use him. I have a number of clients that use him, and he will recommend supplemental insurance if you need it. Everybody's different with that as well. If you have supplemental insurance and you have any challenges with the doctors that Medicare not paying or something like that, you send the bill to Ed's office and they take care of the whole thing for you, again, for free. It's a wonderful service. I have many clients very happy with this service. The last thing I want to talk about is homeowners and auto insurance. I can help people with that as well. Again, put that on your evaluation form at the end. What we do is we have a special company that we go to. You give me your declaration pages. I submit it to them. They shop around to 50 different companies. They come back with an A-rated company that may be a better rate or better coverage for you for your auto or your homeowners or renters insurance. I saved myself about $300 a year. My mother just did it, and we saved her about $1,000 a year, which was great. So we can save a lot of people a lot of different money working with those. So if you're interested in that, let me know. Okay, the main takeaways I wanted to leave you with tonight is diversification is absolutely key. You need to have diversification in your portfolio. If we decide to work together, if you're new to me, then that was one of the things I will look at very deeply with you. Inflation hedges, you've got to have that in your portfolio. Do you have that in your portfolio? Creating income streams that will last for your life. Do you have that? And if you haven't, let's get that created for you. Do you have long-term care? Do you have life insurance that will pay long-term care if you ever need it? Very important to have that. What is your legacy planning? Do you have a trust set up? You need to do that to protect your heirs. Again, we can help with auto and homeowners and Medicare insurance. And my last thing I want to leave you with is have a plan, have a wealth creation assessment done for you. It's very important to do that. So turn in your evaluation forms at the end here when you get them. I do have more webinars coming up. I have a woman's one coming up shortly. So by all means, look at my CaliforniaWealthAdvisors.com and we will go over that as far as what might be coming up your way. Okay, this is what happens when you don't have a plan, and this is my sense of humor, so I hope everybody thinks this is funny, because I think it's funny. When you don't have a plan, things can happen, and we don't want that to happen to you. So make sure you have a plan, that's for sure. So thank you for coming tonight. I really appreciate everybody's attendance here. If you have questions, by all means, send them in to me. Come to my other webinars that I have. Please fill out the evaluation form. It is very helpful for us. And with that, thank you so much. Stay well, everybody, and healthy, and we will see you next time. Thanks so much.